discussing with SPY options chain.
Okay. So should I share my screen now?
Yep, you're good.
Okay. So I think I'm going to just quickly demonstrate setting up a strategy from the options chain. Let's make it a credit put spread. Credit put spreads, popular option strategy. And then we're going to just kind of go through some of the analysis after we set up a credit put spread. And then we'll, see if we have any questions pop up from there. So I'm going to go to the SPY options chain, and I'm going to close this menu just to expand the screen. And what I did was go select an expiration from the left-hand side. So on the left-hand side, here you see these are the different expirations that have options listed in SPY. Next to it, we see the at-the-money implied volatility for that expiration. We see the change in the at-the-money IV from the previous day. We also see the total volume in that expiration. So here on July 10th, we see the implied volatility 7.2. The implied volatility is slightly lower from the previous day, and there are 261,628 contracts that traded. And when you click on it, like I did, you'll see that the July 10th expiration pops up here, and this is the data below. Okay, so maybe let's go to July 12th. It has a little bit more options trading there, but I just want to go out a little bit further since we're setting up a credit put spread. So now we're on July 12th expiration. You can see here, we get some information up here. There are 4 trading days left. There are 4 calendar days left. This will expire this week. And now we have the call information on our left-hand side, the put information on our right-hand side. These are the strikes. And we see the corresponding bids and offers for that option. And let's say we want to set up a put spread, a credit put spread, which would involve the selling a put. So let's do an out of the money put. The stock right now is $555. Let's say we want to sell the 550 put, 83 cents. So you could see when I click on that 83 cents, what happens is that a ticket pops up. Option leg, of course, you can't enter in a trade through here, but a ticket for analysis pops up. And you could see here, because I clicked on the bid, then it automatically picks an action of a sell. Because if you're clicking on a bid, it's implying that you want to sell on that bid. You could change that from here or just change it up here. But this shows you selling the July 12th, 2024 put, the 550 strike 1 at 83 cents. Okay, you could change these, but it auto populates what's on the options chain for you. But a put spread involves selling a put and then buying another put at a lower strike. That's a credit put spread. So let's go ahead and do that. And let's say we do the 545 put, we buy that back, or we buy that for 26 cents. So I'm going to go ahead and click on that 26 cents. And now we get the other leg populate in our analysis for our option profit calculator. So you could see selling the July 12th 550 put, buying the July 12th 545 put, selling 83 cents, buying at 26 cents. So that is a credit put spread. Now that we selected the legs, we want to run an analysis and analyze this strategy. All right. So I'm going to go ahead and hit run analysis. And now this creates this dashboard view of different ways to analyze. Okay. And then on top of that, you get this drop-down menu to go deeper in and further analyze this particular strategy. So let me close this. So in the beginning, what do we have here? Well, first of all, it tells us that doing this credit put spread, if you're selling it for 83 cents and buying it for 26 cents, well, that will result in a 57-cent credit, assuming you're doing it at these prices. Now, how do we compare that benchmark? Like what is 57 cents high or low? We need some kind of benchmark. Like imagine you're out there buying a car, right? Well, different cars have different prices. And if a car or the same car will have different prices based on if it's used, then you have different miles on it or different age. Maybe even the different colors of the car could also impact the price of it. Well, if we're looking at a market price, we want to see, well, what were similar cars selling for? If I'm looking at a car and 2-year-old car, this and that, somebody wants $20,000. Well, how do I know if it's around like a fair price? So we would need some kind of a benchmark, right? Or some kind of theoretical value. In options, we would need some kind of pricing model to generate a benchmark for us. So then we have something to compare. If it's high or low, and if it's high, then we'd have to look for a justification why it's so high. If it's low, maybe there's a justification why it's low, but that's our starting point. So how do we compare this? Well, for one, we could say in theory, based on how the stock moves, so we could look at the historical stock returns, right? And we'll say, well, okay, with 4 days to go, the stock is this far away from each strike. And, putting all that together, the implied volatility regime is over here. Based on that historical stock movement over a certain date range, and I think I have it set to 4 years, but you could go here and reset that in here. So let me see what I have it set to. So I have it for 4 years, okay? But you could change it and actually set it as default. But let's just stick with that. Come back to the summary. So based on that history, on average, if we took the average of all those end values, theoretical end values, sometimes the stock went down, this would have been worth more, sometimes went up. On average, theoretical value was 62 cents. So from that perspective, 57 cents, is below that, 5 cents below that average. And that doesn't mean necessarily, that it's going to end up being a loser. We don't know. It could still go to zero, but if we just use the average, it's a little bit below. How about the win rate though? It is below, right? But sometimes, you could have some outliers. You could, because this put spread could be worth $5 if the stock goes far down deep enough. So if we just use the 57 cents, historically, based on how the stock moves, how often would have it resulted in a profit? Meaning at the end of the 4 days, based on how the stock moved, how often did it result in a profit, which means it would be worth less than 57 cents? Because if you're selling at 57 cents, you want it to go lower, right? You want to buy back cheaper, or you want it to go out worthless. So based on history, this is saying 84% of the time in the last 4 years over 4-day period with similar, volatilities and so forth, 84% of the time, this would have resulted in some profit, meaning it was cheap. Could have been 56 cents, 55 cents, or zero. So that's another way to look at it. What about another theory? It's not, but there's no one correct way. And that's why we put two of them. There's no one correct way or model, that says this has to be exactly the price, because we're dealing with an estimate, right? We're dealing with benchmarks and estimates. Just like if you're pricing a car, you're still doing estimates, because it's like, you're looking at how much data are you using, how far back and so forth. So we create another model and say, well, let's take away for now how the stock performed, and let's look at the options, prices, and implied volatilities in the similar situation. So irrelevant like how the stock did, if we look back in history, how the options chain looked with these implied volatilities, right? What would have been the average price? What were the options looking like with 4 days to go in similar situation? So that shows that on average, this spread historically was 77 cents. So that's using the Black-Scholes model, looking at the historical implied volatilities of similar options, similar days to expiration, similar strikes away. Well, if on average it's worth 77 cents, how does that compare to what it is now? Well, if you're selling it at 57 cents, but the average value historically was 77 cents, well, that's now you're going 20 cents below the historical average. Right? So the implied volatilities right now look like they're lined up on the low end of the historical range. So let's keep looking. Well, what about the middle part, right? This is the average, so the average could get skewed. What would, if we took half of the historical observations to the downside, and then we took half of them to the upside, we looked right in the middle, the median was 74 cents. So this is still well below. And what about the range, the high-low range? So we see that our historical range was as low as 44 cents, as high as 134. So looking at that, we're not at the low, but we're closer to the lower end. Okay, so not a lot of juice pumped up in that credit put spread. So let's come down here. This here just shows us what the midpoint is and what the bid-ask spread is. And the reason for that is if the bid-ask spread is wide, you have to take that into consideration, because that is the cost of execution. Right? That's what you're looking at. Well, how do I get a good execution, good quality execution? So you want to look at that spread. So here the spread isn't very wide, 2 cents wide. Midpoint is 58 cents. So you want to be aware of that, because when you're trying to execute a trade, you want to get the best price possible. Right? If you're selling, you want to get the highest price possible. If you're buying, you want to get the lowest price possible. Right? Because the lower you buy, you have less risk and higher potential reward. The higher you sell, the less risk you have with potential greater reward. Right? So the more you sell this, the more potential reward. And the more you sell it, well, now you have more cushion, less risk. So here, this is just showing us the the midpoint so we could compare it really quickly to the 57 and then the spread, bid-ask spread. So if we slide down here, this is showing us something interesting here. This is how this spread performed today. Well, on the day we're closed. So this was on the day yesterday. So this yellow line here shows us how the spread moved around yesterday. Okay. Then we have this little red dotted line and green dotted line. Well, that shows us the bid of the spread. The green one shows us the ask of the spread. And the midpoint is the yellow line. And these are snapshots. So keep in mind, we're looking at mark to market. We could look at it from the graph, or we could just look at our table and say, okay, what was the high point? 72 cents, low point, 49 cents, the median, average. And we could see it started out at 58 cents and it ended up at 58 cents. So even though it moved around, at the end of the day, this spread went out the same price it started. And you could see here, we also showed the bid-ask spread to see how tight that spread remained throughout the day, which seems like pretty consistent at 2 cents. Okay. And if I slide down here, here's something else interesting, is that this very spread, even though, I entered it in, just randomly selected it for demonstration, what the machine picked out is that this spread actually traded yesterday. There are put spreads that were entered in as multi-leg trades for this combination. It traded 19 times yesterday for total volume of 232 contracts. So those are looking for spreads, not single leg trades. Okay, well, what did it trade for? Well, we see here, they traded for an average weighted price of 56 cents. And at the time of the trade, the average weighted bid was 56 cents, average weighted 58 cents. So it looks like it traded basically on the bid with an average volume weighted stock price of 555.97. So you can see that it ended up a little bit higher, 2 cents higher than where the VWAP traded. But now we have some good reference numbers as we analyze it. Right? Now we know theoretically what it's worth. We've seen what it did on the day, and we've seen like where it actually traded on the day. So finally, we have a payout diagram that shows us the risk and reward at expiration. Right? So you can see here, there's the current stock price up here. So as long as the stock stays above the 550, you're making that credit, 57 cents. If it drops all the way down here, you lose $443 because it's worth $5 if it drops below that 540 strike. So here we have the table with the statistics. We see this right now, the spot was 555.02. Right? That's where the spot was of this last snapshot, 555.02. Well, our break even here is 549.43 because we sold the 550 put, bought the 545 put, right? So if it goes below 550, we start losing, but we did receive a credit of 57 cents. So our break even is 549.43. Okay, so how much of a cushion? That means it can still go down, and we're not losing until it hits that 549.43. Well, how much of a cushion? We see it's 1%. So the stock has we have a little bit now to the upside. We're good, right? To the upside at this point, we're good. To the downside, that's our risk. How much of a cushion? 1%. Right? Our max gain, the stock has to be above 550. Right now it's 555, but it has to be above 550 at expiration. And then both puts expire worthless. So how far are we for a max gain? Well, keep in mind, it can go down, right? So at 555, it doesn't necessarily have to go up. If it stays here, we're good. If it goes up, it's good. Even if it goes down, we're still good, but it's got to be above a certain amount. So that's above 0.9%. So it can't go below that much. We have until we get, we hit it. So our max gain is above that. So let's now look at the option. That's from the stock's point of view. Right now, the spread is 57 cents. So because it's a credit, that's the most we would make is 57 cents. Well, how much are we risking? Well, we're risking $443, right? 57 cents, we're risking 443 because if the stock collapses, that it could be worth $5. The spread can be worth $5. Well, so how much can we make on the amount we have at risk? So if we're risking 443 and the max gain is 57 cents, then our max gain is 12.9%. So in 4 days, if this scenario is that it's above 0.9%, you're going to yield 12.9% on the amount at risk. What if the stock just stays flat, nothing happens, then your yield is still 12.9% because all those options will expire worthless. So that we covered that credit put spread, Will. We're right up at 9:30. I'm going to stop there.
Awesome job, D. Remember, everyone, we have a webinar today at 2 p.m. It's an IBKR webinar on stock volume bursts. The link to that webinar is in the chat. We did have a couple questions from Rob and Pradeep. I'll send those to you. Maybe we can focus on them tomorrow's show. Great job, D, as always. And remember, actually, Thursday and Friday, I'm away for a family event, so we won't have a show on Thursday and Friday. So tomorrow's show will be the last show of the week, and then we'll restart the following Monday. Awesome job, D.
All right. Thanks, everyone, for joining. Stay safe out there. Have a great trading day. Hope to see you guys later this afternoon. If not, maybe tomorrow.
Yep. Great job, D. Trade and peace.